Okay, let's dive into this. Buying your first home is, well, it's an incredibly exciting milestone, right? But honestly, absolutely nothing bursts that bubble quite like the sheer shock of your first mortgage estimate. So today, in this explainer, we're going to completely demystify the true cost of buying a home. Here is our quick roadmap for today. We're looking at 5 steps: the monthly payment shock, breaking down PITI, how escrow accounts work, a real monthly payment example, and finally, avoiding common budgeting mistakes. We've got a really structured, easy to follow plan to break down all this heavy financial jargon for you.
All right, section 1, the monthly payment shock.
This is a highly relatable scenario for nearly every first time buyer out there. You finally find the perfect house, you run the numbers, and then reality hits. Why is your mortgage estimate almost always higher than you expected? It's a super frustrating pain point. You plug the home price into a basic calculator online, you feel great about the number, but then when you get the official paperwork from your lender, bam, it's significantly higher.
For example, you might calculate a monthly payment online at $1,700 and feel pretty confident you can afford it. But a few days later, your lender estimates your actual monthly payment is going to be $2,250. Nothing changed about the home, and nothing changed about the loan amount. So where on earth did that extra $550 actually come from?
Let's move to section 2, breaking down PTI, and see how this all builds.
The secret behind that sudden price jump, it's usually hidden in a specific 4-letter financial acronym, PITI. That stands for principal, interest, taxes, and insurance. These are the 4 basic elements that make up your true monthly mortgage payment. Lenders scrutinize this foundational formula to determine your total housing expense and calculate your debt-to-income ratio. This is exactly how they decide if you can actually afford the loan.
Let's look at each part individually, starting with the P. P is for principal. This is simply the amount of money you are borrowing from the lender to buy the home. For example, if you buy a $400,000 home and put $80,000 down, your principal is that remaining $320,000. Every single payment you make toward the principal reduces your remaining loan balance, which gradually builds your equity in the home.
Next up is I, which stands for interest, because, borrowing money isn't free. Interest is the cost charged by the lender for providing the funds you need to make the purchase. Now, because of how loan amortization works, during the early years of a standard 30-year fixed mortgage, a very large portion of your monthly payment goes strictly toward paying this interest, not the principal. This means you're building equity a bit slower than you might think in those first few years.
Then we have the T, which stands for taxes, specifically local property taxes. These are collected by your local government to fund things like public schools, roads, police, and fire departments. It's absolutely crucial to understand that property taxes vary widely depending on the exact location and the assessed value of the home. That's exactly why 2 similar homes in different cities or even different counties can cost very different amounts per month. Finally, the last I is for insurance. Lenders require homeowners insurance to protect their collateral, which is your house, against unexpected damage like fires, theft, or severe weather. Plus, if your down payment is under 20% of the property value, this I will likely also include private mortgage insurance, or PMI. PMI is just an extra monthly fee that protects the lender in case you fall behind on your payments. Now, what's really interesting about this next part? Let's look at section 3, how escrow accounts work. So, how are the taxes and insurance pieces of that puzzle actually managed by your bank? Well, an escrow account is essentially a special deposit account managed by your mortgage lender. It's designed to hold funds specifically for your property taxes and homeowners insurance. Instead of getting hit with massive annual bills for thousands of dollars all at once, escrow is a super helpful financial tool that breaks those daunting expenses down into manageable, bite-sized monthly chunks. In practice, it works in 3 simple steps. First, you make your single monthly PITI payment directly to your lender. Second, the lender takes the principal and interest portions to pay down your loan, but they hold the tax and insurance portions safely in this escrow account. Finally, when those big annual tax and insurance bills become due, the lender automatically pays the proper authorities on your behalf using the funds from your escrow account. It basically keeps everything paid in full and right on time without you having to lift a finger.
Moving right along to section 4, real monthly payment example, let's really visualize exactly where your money goes. Let's look at a real-world mathematical breakdown for a $2,125 PITI payment. Principal and interest form the core of it at $1,650. But taxes at $350 and insurance at $125 add a hefty $475 to your monthly obligation. That $475, that is so often the missing puzzle piece when buyers use basic online calculators that only factor in the loan, principal, and interest. So the crucial point is applying this knowledge. Let's get into Section 5, avoiding common budgeting mistakes. Applying all this helps you avoid the traps that snag a lot of first-time buyers. For instance, if your PITI payment is $2,125, your true total housing costs might actually be $2,225. Why? Because of a $100 Homeowners Association or HOA fee. HOA fees help maintain shared community amenities, and they are a massive blind spot because they're usually completely separate from PITI and not paid through your escrow account. Yet they are absolutely a required monthly housing expense. Let's rapidly review some of the most common budgeting mistakes first-time buyers make. A really big one is budgeting using only principal and interest. It's also surprisingly common to completely forget about property taxes, or just blindly assume they're going to be exactly the same in every neighborhood. Many buyers ignore the cost of homeowners insurance, or totally overlook those sneaky HOA fees we just talked about. And lastly, it's so easy to forget to account for potential escrow shortages, where property taxes or insurance premiums naturally increase over time, requiring you to make up the difference. Overlooking these realities, along with regular maintenance and utilities, is just a fast track to intense financial stress. I want you to remember this. A realistic budget today can prevent financial stress tomorrow. Understanding every single part of your monthly payment is literally the key to avoiding financial surprises down the road. Armed with a clear understanding of PITI, HOA fees, and exactly how escrow works, you can confidently shop for a home that actually fits your real-world budget, not just an internet calculator's fantasy. To wrap up this explainer, I want to leave you with this impactful final question to really think about. Are you budgeting for a loan, or are you budgeting for a home? Because as we've seen today, there is a massive difference between the two. Thank you so much for joining me, and I hope this empowers you to take that exciting step into homeownership with absolute financial clarity.